Market outlook, the week ahead in global FX and macroeconomics. Global markets head into the new week digesting a mix of political tension, weak US data, and growing geopolitical risks. The US government shutdown dominated sentiment last week, dragging the US dollar lower against most major currencies. Political gridlock in Washington, with Republicans saying they will have nothing to negotiate. Deepened investor worries over growth and fiscal stability, setting a cautious tone for the week ahead. The latest US data releases added fuel to the pessimism. The ADP employment report shocked markets with a 32,000 job loss, the first negative print in years, while the ISM Services PMI tumbled to 50.0, barely clinging to expansion territory. Its business activity sub-index slipped below 50 for the first time since 2020, reinforcing fears that the US economy may be losing steam. Amid this backdrop, safe haven demand surged as investors sought shelter from uncertainty. The Japanese yen emerged as the week's top performer, supported by both risk aversion and increasingly hawkish signals from the Bank of Japan, BOJ. Meanwhile, Russia's warning of appropriate responses to possible US Tomahawk missile supplies to Ukraine further heightened geopolitical anxiety. Central bank watch US Federal Reserve Fed officials continue to strike conflicting tones. Governor Waller hinted at potential rate cuts in early 2025, while Presidents Hammack and Logan stressed that inflation risks remain elevated. The divergence highlights uncertainty over how prolonged the US shutdown might impact growth and policy direction. Bank of Japan. The Bank of Japan's September summary of opinions revealed sharper internal divisions, with two members openly calling for interest rate hikes. Deputy Governor Uchida said Japan's business sentiment continues to improve despite US tariffs, reinforcing speculation that the BOJ is preparing to further normalize policy. European Central Bank ECB President Christine Lagarde signaled that rates are in a good place, implying a pause in easing even as Eurozone PMIs remain subdued. Board member Makhlouf added that the bank is near the bottom of the easing cycle, providing modest support for the euro amid lingering inflation at 2.2%. Reserve Bank of Australia, RBA. The RBA kept rates steady at 3.60% but adopted a hawkish tone, warning that Q3 inflation could be higher than expected. This statement effectively delayed market hopes for near-term rate cuts, reflecting a cautious stance amid weakening trade data and falling commodity prices. Economic highlights: the US labor and services data stole the spotlight, signaling growing cracks in economic resilience. The ADP employment loss of 32,000 was a major surprise, while the ISM manufacturing PMI remained soft at 49.1. The ISM Services PMI at 50 underscored weakening business confidence. Across other regions, Eurozone inflation stayed sticky at 2.2%. Keeping the ECB cautious. Australia's trade surplus fell sharply to 1.83 billion as exports plunged nearly 8% month on month, pressuring the Aussie dollar. New Zealand's building permits rebounded 5.8%, while Japan's Tankan manufacturing index slipped slightly to 14.0, reflecting steady but slower business sentiment. Market reactions and risk themes. The US shutdown shock triggered classic risk-off flows, boosting demand for JPY and CHF. Oil prices collapsed towards $60 following reports of increased OPEC plus production, slamming commodity currencies, especially the Canadian dollar, which ended the week as the weakest performer. Conversely, gold rallied above 3,900s, benefiting from haven flows and lower yields, which lent mild support to the Australian dollar AUD despite poor trade data. Geopolitical concerns, particularly Russia's renewed warnings, added to volatility, keeping traders defensive heading into the new week. Outlook for the week ahead: markets enter the new week with risk sentiment fragile and monetary policy divergence widening across major economies. Investors will closely watch US CPI and retail sales data for confirmation of slowing momentum, BOJ commentary for signs of a policy shift, and OPEC updates after oil's steep decline. With political uncertainty in Washington unresolved and inflation still sticky in parts of the world, traders should expect continued volatility across forex, commodities, and indices. The balance between economic slowdown fears and central bank caution will define market direction, and safe haven demand may stay elevated if US politics and geopolitics offer no relief.